Australia's largest banks have endured a controversial year, defined by public relations nightmares and opportunistic government interventions which have taken their toll on bank share prices. We believe this negative background provides a trading opportunity with the October and November earnings season as a catalyst for re-evaluation. Bank profitability is determined by a few simple factors: the cost of funds, what the banks charge to lend funds, asset quality, and the amount of capital they need to hold. The key measure of bank profitability is the net interest margin, the difference between interest income received from customers and interest paid to lenders relative to the bank's assets. If we take a closer look at the cost of funds, term deposit rates have fallen from the elevated 2016 levels due to increased competition for funds as the banks move to adhere to liquidity requirements under the global Basel III banking reforms. This will provide a tailwind for banks' earnings in the next reporting period. The reforms are focused on amending the composition of banks' funding and view term deposits as a favourable component. Wholesale funding to banks has been flat to slightly down, reducing interest paid in the NIM equation. On the income side, banks have repriced mortgages multiple times this year through out-of-cycle interest rate increases, and we expect this to contribute to a strong reporting period. The banks with the most exposure here are the big mortgage banks of Commonwealth Bank and Westpac. While the bank tax still needs to be accrued, overall we expect banks to deliver strong net interest margins and increased earnings. The quality of bank lending, including housing, business and personal loans, remains sound, with issues confined to pockets in Western Australia and regional Queensland. We expect the banks to deliver benign asset quality reports and low non-performing loan rates. However, we will closely examine personal lending for any deterioration given pressures on household spending from increased energy and mortgage costs amid stagnant salary growth. The large specific charges should be low given there have been no big name collapses this period. For the first time in the sector's recent history, we think capital will be a non-event this reporting period. We expect the major banks will move well along the curve towards the APRA required capital ratio of 10.5%, as divestments and capital generation add to the healthy positions reported last quarter. Given their strong capital positions, we expect the banks will meet or exceed the market's expectations regarding dividends. In our view, dividends will at least be maintained. The Bank of Queensland commenced the sector's reporting period on Thursday, the 12th of October 2017, with a sound result. The remaining banks set to report later this month and throughout November. BOQ's positive result confirmed many of our estimations. We believe the sector as a whole stands to surprise the market, and we are particularly positive about NAB and Westpac. We think CBA result will be solid, and we think the share price reaction has more than compensated investors for any likely fallout in the anti-money laundering case.